Question 1. A business reports a positive accounting profit after paying wages, rent, materials, and interest on borrowed funds. However, the owner's foregone salary and the return available from personally invested capital exceed the reported profit. Which conclusion is most appropriate? A. The business has recovered all economic costs. B. The business covers recorded costs but not all opportunity costs. C. The owner must record personal time as a cash expense. D. The business must have earned negative total revenue. The correct answer is B. Let's break this down. Accounting profit considers explicit costs such as wages, rent, materials, and interest payments. However, economic profit also includes implicit costs, such as the salary the owner gives up and the return forgone by investing personal capital in the business. Since those opportunity costs exceed the accounting profit, the business covers its recorded costs, but not all economic costs. Therefore, option A is incorrect because all economic costs have not been recovered. Option C is incorrect because foregone salary is an opportunity cost rather than a cash expense. Option D is incorrect because positive accounting profit does not mean that total revenue is negative. Question 2. A publishing firm has substantial editorial and platform costs but relatively low distribution costs per digital copy. What does high operating leverage imply for the firm? A. Sales changes have little effect on operating profit. B. Fixed costs fall automatically as sales increase. C. Sales changes can cause large changes in operating profit. D. Variable costs become unrelated to output volume. The correct answer is C. Here is why. High operating leverage occurs when a business has a large proportion of fixed costs relative to variable costs. In this case, editorial and platform costs must be paid regardless of how many digital copies are sold. Therefore, a relatively small change in sales revenue can create a much larger change in operating profit. Option A is incorrect because high operating leverage increases profit sensitivity to sales changes. Option B is incorrect because fixed costs do not automatically decrease as sales rise. Option D is incorrect because variable costs can still vary with output even when they are relatively low. Question 3. A firm reports that it has a wide margin of safety. What does this indicate? A. Its price exceeds marginal revenue by a large amount. B. Its fixed costs are low relative to variable costs. C. Its actual sales are well above break-even sales. D. Its total revenue equals total economic cost. The correct answer is C. Let's examine the concept. The margin of safety shows how far actual or expected sales are above the break-even level. A wide margin of safety means the firm can withstand a substantial decline in sales before, therefore, actual sales are well above break-even sales. Option A is incorrect because margin of safety does not compare price with marginal revenue. Option B is incorrect because the measure focuses on sales relative to break-even sales, not the mix of fixed and variable costs. Option D is incorrect because total revenue equaling total economic cost describes an economic break-even position. Question 4. Which assumption is central to a simple cost-volume profit model within a relevant operating range? A. Unit selling price changes with each output unit. B. Unit variable cost remains constant as volume changes. C. Total fixed cost falls as each unit is sold. D. Product mix changes whenever sales volume rises. The correct answer is B. Now let's clarify the assumption. Cost volume profit analysis assumes that the unit selling price and unit variable cost remain constant within the relevant operating range. Therefore, producing or selling additional units does not change the variable cost per unit. Option A is incorrect because the selling price is assumed to remain stable. Option C is incorrect because total fixed cost remains unchanged within the relevant range. Option D is incorrect because the product mix is assumed to stay constant when multiple products are involved. Question 5. A university evaluates the cost of delivering its postgraduate analytics program separately from its other programs. The postgraduate analytics program is the A. Cost pool, B. Cost object, C. Cost driver, D. Cost allocation base. The correct answer is B. Let's distinguish the terms. A cost object is anything for which an organization wants to measure or assign costs. In this case, the postgraduate analytics program is being evaluated separately, so it is the cost object. A cost pool is a group of similar costs collected together before allocation. A cost driver is the factor that causes costs to change, such as the number of students or teaching hours. A cost allocation base is the measure used to distribute pooled costs across cost objects. Question 6. Evaluate each statement as true or false. A direct cost can be traced to a cost object using economically feasible methods. The correct answer is true. Period costs are generally expensed in the period in which they are incurred. The correct answer is true. A cost can be direct to one cost object and indirect to another. The correct answer is true. Indirect costs can never be assigned using a rational allocation base. The correct answer is false. Let's examine each statement. A direct cost has an identifiable relationship with a specific cost object and can be traced to it without excessive effort or cost. Period costs, including many selling and administrative costs, are charged against the accounting period in which they are incurred. Furthermore, whether a cost is direct or indirect depends on the cost object being measured. For example, a lecturer's salary may be direct to a particular program, but indirect to the wider faculty. Finally, indirect costs can be allocated using rational bases, such as labor hours, machine hours, or floor space. Question 7. A manufacturer replaces a single overhead allocation method with separate activity pools for machine setups, inspections, and purchase orders. What is the primary advantage of this approach? A. It removes all fixed costs from production. B. It guarantees identical product costs across departments. C. It treats every overhead cost as a direct cost. D. It links overhead assignment more closely to resource consumption. The correct answer is D. Let's look at the benefit. Activity-based costing separates overhead into activity pools, such as setups, inspections, and purchase orders. Each pool is then assigned using a cost driver that reflects how the activity consumes resources. Therefore, costs are allocated more accurately to products based on the activities they actually require. Option A is incorrect because fixed costs still exist under activity-based costing. Option B is incorrect because different products and departments can consume activities at different levels. Option C is incorrect because overhead remains indirect even though it can be assigned more precisely. Question 8. A chemical process produces a major commercial product and a small secondary output that can be sold with minimal additional processing. The secondary output is most appropriately classified as A. Joint product, B. Process loss, C. Transfer item, D. Byproduct. The correct answer is D. Let's separate the classifications. A byproduct is a secondary output with relatively low sales value compared with the main product produced through the same process. Since this secondary output can be sold but is not the primary commercial focus, it is classified as a byproduct. Option A is incorrect because joint products have significant sales value relative to each other. Option B is incorrect because process loss refers to output that is lost, wasted, or unusable during production. Option C is incorrect because a transfer item does not describe a secondary output from a joint production process. Question 9. Which statement best distinguishes marginal cost from incremental cost? A. Marginal cost includes fixed cost, while incremental cost excludes it. B. Marginal cost concerns one additional unit, while incremental cost concerns a defined activity change. C. Marginal cost applies only in the long run, while incremental cost applies only in the short run. D. Incremental cost excludes opportunity cost, while marginal cost includes it. The correct answer is B. Let's clarify the difference. Marginal cost measures the additional cost of producing one more unit of output. Incremental cost has a broader meaning because it measures the cost impact of a specific change in activity or decision. For example, incremental costs could assess the effect of adding a new product line or accepting a special order. Option A is incorrect because either type of cost may include relevant fixed costs when those costs change. Option C is incorrect because both concepts can be used in short-run and long-run decisions. Option D is incorrect because opportunity costs may be relevant to either decision when applicable. Question 10. A manager compares the future costs of using two alternative suppliers. The difference between the total relevant costs of the alternatives is called A, sunk cost, B, allocated cost, C, carrying cost, D, differential cost. The correct answer is D. Let's identify the cost term. A differential cost is the difference in total relevant cost between two alternatives. In this case, the manager is comparing supplier options, so the focus is on the costs that change between those choices. Option A is incorrect because sunk costs were incurred in the past and cannot be changed by the current decision. Option B is incorrect because allocated cost refers to a cost assigned to a cost object using an allocation method. Option C is incorrect because carrying cost relates to holding inventory over time. Question 11. Which cost is generally classified as non-value adding in a production process? A. Installing a component required by product design. B. Reworking units that failed initial specifications. C. Processing materials into the required final form. D. Testing a product required by safety standards. The correct answer is B. Let's identify the waste. Rework occurs when units fail to meet specifications and must be corrected before they can be used or sold. This activity consumes labor, materials, and time without adding value from the customer's perspective. Therefore, rework is generally classified as non-value adding. Option A is incorrect because installing a required component contributes directly to the product's intended design. Option C is incorrect because processing materials into the required form is necessary to create the final product. Option D is incorrect because safety testing may be necessary to meet legal or customer requirements. Question 12. A retailer's sales decline sharply, but supervisory salaries decline only slightly because managers retain staff in anticipation of recovery. This pattern illustrates A. Cost stickiness, B. Constant returns, C. Revenue maximization, D. Productive efficiency. The correct answer is A. Let's examine the pattern. Cost stickiness occurs when costs decrease less sharply when activity declines than they increase when activity rises. In this case, supervisory salaries remain relatively high because the retailer keeps staff in place while expecting sales to recover. Therefore, the cost does not fall in proportion to the decline in sales. Option B is incorrect because constant returns concern the relationship between input and output. Option C is incorrect because revenue maximization focuses on achieving the highest possible revenue. Option D is incorrect because productive efficiency concerns producing output with the least possible resources. Question 13. A laboratory estimates testing costs using the number of patient visits, even though most resources are consumed by specimen complexity. What is the primary concern? A. The laboratory has eliminated all fixed costs. B. The cost estimate may lack a causal relationship with resource use. C. The laboratory has converted indirect costs into sunk costs. D. The estimate guarantees a stable marginal cost curve. The correct answer is B. Let's consider the driver selection. A reliable cost driver should have a meaningful cause and effect relationship with the resources being consumed. In this situation, specimen complexity drives most testing resources, not simply the number of patient visits. Therefore, using patient visits could produce inaccurate cost estimates. Option A is incorrect because choosing an unsuitable cost driver does not eliminate fixed costs. Option C is incorrect because indirect costs do not become sunk costs through allocation. Option D is incorrect because the selected driver does not guarantee any particular marginal cost pattern. Question 14. A logistics company compares the acquisition, maintenance, energy, downtime, insurance, and disposal costs of several delivery vehicles over their useful lives. This approach is known as A. Marginal costing, B. Standard costing, C. Absorption costing, D. Life cycle costing. The correct answer is D. Let's identify the approach. Life cycle costing evaluates all relevant costs associated with an asset from acquisition through to disposal. In this case, the company considers purchase, maintenance, energy, downtime, insurance, and disposal costs across each vehicle's useful life. Therefore, this provides a broader view of the total cost of owning and operating each vehicle. Option A is incorrect because marginal costing focuses on the additional cost of one more unit or activity change. Option B is incorrect because standard costing uses predetermined costs for planning and control. Option C is incorrect because absorption costing assigns production costs to units produced. Question 15. A firm evaluating cloud software includes subscription, migration, training, integration, support, security, and eventual exit costs. This perspective reflects A. Total cost of ownership, B. Marginal revenue analysis, C. Average variable costing, D. Short-run shutdown analysis. The correct answer is A. Let's consider the full cost perspective. Total cost of ownership considers all relevant costs associated with obtaining, implementing, operating, supporting, securing, and eventually replacing or exiting a solution. In this case, the firm is looking beyond the subscription price to include migration, training, integration, support, security, and exit costs. Therefore, this approach gives a more complete view of the software's financial impact over time. Option B is incorrect because marginal revenue analysis focuses on the additional revenue earned from an extra unit of output. Option C is incorrect because average variable costing focuses only on variable cost per unit. Option D is incorrect because short-run shutdown analysis considers whether a business should continue operating in the short term. Question 16. Which curve shows alternative combinations of labor and capital capable of producing the same output level? A. Isocost curve, B. Demand curve, C. Isoquant curve, D. Supply curve. The correct answer is C. Let's distinguish the curves. An isoquant curve shows every possible combination of labor and capital that can produce the same level of output. For example, a firm may use more labor and less capital or more capital and less labor while maintaining the same output quantity. Option A is incorrect because an isocost curve shows combinations of inputs that have the same total cost. Option B is incorrect because a demand curve shows the relationship between price and quantity demanded. Option D is incorrect because a supply curve shows the relationship between price and quantity supplied. Question 17. Why cannot two isoquants representing different output levels intersect? A. One input combination cannot represent two different output levels under the same technology. B. Input prices prevent firms from using more than one production method. C. Marginal revenue always exceeds marginal cost at the intersection point. D. Fixed costs prevent output from changing when capital changes. The correct answer is A. Let's reason through it. Each isoquant represents a specific output level using different possible combinations of inputs. If two isoquants intersected, the intersection point would show the same combination of labor and capital producing two different quantities of output. Under the same production technology, that is not possible. Option B is incorrect because input prices affect cost decisions, not whether isoquants can intersect. Option C is incorrect because marginal revenue and marginal cost are unrelated to the shape or intersection of isoquants. Option D is incorrect because fixed costs do not determine whether one input combination can produce different output levels. Question 18. Evaluate each statement as true or false. Committed fixed costs can usually be changed quickly by frontline managers. The correct answer is false. Discretionary fixed costs are legally unavoidable once a budget has been approved. The correct answer is false. Step costs vary continuously with every additional unit of activity. The correct answer is false. A valid cost driver should help explain why a cost changes. The correct answer is true. Let's break down the cost behavior concepts. Committed fixed costs usually arise from long-term capacity decisions, such as leases, equipment, or salaried management contracts. Therefore, frontline managers cannot normally change them quickly. Discretionary fixed costs, such as advertising or staff training budgets, can usually be adjusted through management planning. Step costs remain fixed within a specific activity range and then increase when capacity limits are reached. Finally, a valid cost driver should have a logical cause and effect relationship with the costs being estimated. Question 19. Along a typical convex isoquant, diminishing marginal rate of technical substitution means that A. Additional labor replaces progressively less capital as labor use rises. B. Additional capital always reduces total output. C. Input prices become equal as output expands. D. Marginal cost becomes constant at every output level. The correct answer is A. Let's interpret the curve. Along a convex isoquant, labor and capital can substitute for each other while output remains unchanged. However, as the firm uses more labor and less capital, each additional unit of labor replaces a smaller amount of capital. This is called a diminishing marginal rate of technical substitution. Option B is incorrect because additional capital does not necessarily reduce output. Option C is incorrect because input prices are not determined by the isoquant. Option D is incorrect because marginal cost is separate from the technical substitution between inputs. Question 20. A production process requires one specialized scanner for every technician, with no possibility of replacing one input with the other. The isoquant for this technology is most likely A. Linear, B. L-shaped, C. Circular, D. Vertical. The correct answer is B. Let's identify the input relationship. When inputs must be used together in fixed proportions, they are known as perfect complements. In this case, each technician requires one specialized scanner, so adding more of one input without the other does not increase output. Therefore, the isoquant is L-shaped. Option A is incorrect because a linear isoquant represents perfect substitutes. Option C is incorrect because circular isoquants do not represent the typical relationship between production inputs. Option D is incorrect because a vertical line would indicate that only one input determines output. Question 21. An isocost line represents A. Output combinations that yield identical revenue. B. Labor combinations that maximize marginal product. C. Input combinations that have the same total cost. D. Output levels that produce equal average cost. The correct answer is C. Let's clarify the concept. An isocost line shows all combinations of inputs, such as labor and capital, that a firm can purchase for the same total expenditure. Its position depends on the firm's budget and the prices of those inputs. Therefore, option C is correct because every point on the line has the same total cost. Option A is incorrect because equal revenue relates to sales or output conditions, not input expenditure. Option B is incorrect because marginal product concerns how inputs affect output. Option D is incorrect because average cost refers to cost per unit of output rather than combinations of inputs. Question 22. Assume labor is measured on the horizontal axis and capital on the vertical axis. If the wage rate rises while the rental rate of capital remains unchanged, the isocost line will A. Shift outward in a parallel manner, B. Become steeper and pivot inward around the capital intercept, C. Become flatter and pivot outward around the labor intercept, D. Remain unchanged because output has not changed. The correct answer is B. Let's track the effect of the wage change. An isocost line shows the combinations of labor and capital a firm can buy with a fixed budget. When the wage rate rises, the firm can afford less labor for the same total cost. Therefore, the labor intercept moves inward while the capital intercept remains unchanged because the rental rate of capital has not changed. This makes the isocost line steeper and causes it to pivot inward around the capital intercept. Option A is incorrect because a parallel outward shift would result from an increase in the total budget. Option C is incorrect because a higher wage makes the line steeper rather than flatter. Option D is incorrect because isocost lines depend on input prices and total expenditure, not output level. Question 23. As a firm increases its desired output level while input prices remain unchanged, the locus of its cost-minimizing input combinations is called the A. Production possibility frontier, B. Expansion path, C. Marginal revenue curve, D. Average cost envelope. The correct answer is B. Let's identify the relationship. The expansion path traces the cost-minimizing combination of inputs, such as labor and capital, at different output levels. As the firm seeks to produce more output while input prices remain unchanged, it chooses the least cost input combination at each level. Connecting those optimal combinations creates the expansion path. Option A is incorrect because a production possibility frontier shows the maximum possible output combinations of different goods. Option C is incorrect because a marginal revenue curve shows how revenue changes when one more unit is sold. Option D is incorrect because an average cost envelope describes cost curves across different production scales. Question 24. A production process has a high elasticity of substitution when A. Output remains fixed despite major input changes, B. Total cost remains unchanged after a wage increase, C. Inputs must always be used in fixed proportions, D. Inputs can be readily substituted after relative price changes. The correct answer is D. Let's interpret the concept. A high elasticity of substitution means a firm can easily replace one input with another when their relative prices change. For example, if wages rise, a firm may be able to use more machinery and less labor while maintaining the same output level. Therefore, the production process is flexible in how it combines inputs. Option A is incorrect because elasticity of substitution concerns changing input combinations, not keeping output fixed despite input changes. Option B is incorrect because a wage increase can affect total cost even when inputs are easy to substitute. Option C is incorrect because fixed proportion inputs are perfect complements and have very low elasticity of substitution. Question 25. Which statement correctly distinguishes returns to scale from economies of scale? A. Returns to scale concerns price changes, while economies of scale concerns output demand. B. Returns to scale concerns revenue, while economies of scale concerns market structure. C. Returns to scale holds input proportions constant, while economies of scale examines long-run average cost. D. Returns to scale applies only to monopoly firms, while economies of scale applies only to competitive firms. The correct answer is C. Let's separate the two ideas. Returns to scale examines how output changes when all inputs increase proportionally while their relative proportions remain constant. Economies of scale, however, examine how long-run average cost changes as the scale of output increases. Therefore, returns to scale is a production concept, whereas economies of scale is a cost concept. Option A is incorrect because neither concept is primarily about price changes or output demand. Option B is incorrect because returns to scale does not measure revenue, and economies of scale does not define market structure. Option D is incorrect because both concepts can apply to firms in different market structures. Question 26. A public transport operator carries more passengers on the same route network and experiences lower average cost per passenger without expanding its route coverage. This is an example of A. Diseconomies of scope, B. External economies, C. Economies of density, D. Constant returns to scale. The correct answer is C. Let's identify the source of the cost saving. Economies of density occur when a firm serves more customers within its existing network or geographic area, causing average cost per customer to fall. In this case, the operator carries more passengers on the same routes without expanding coverage. Therefore, the existing buses, terminals, and route infrastructure are used more intensively. Option A is incorrect because diseconomies of scope occur when producing multiple products or services together raises cost. Option B is incorrect because external economies arise from benefits created outside the firm, such as improved local infrastructure or supplier clusters. Option D is incorrect because constant returns to scale means output increases in the same proportion as all inputs without a fall in average cost. Question 27. Several firms in a technology cluster benefit because specialized suppliers, skilled workers, and shared research facilities become available locally. These cost savings are A. Internal diseconomies, B. External economies, C. Technical inefficiencies, D. Marginal revenue gains. The correct answer is B. Let's identify where the benefit comes from. External economies arise when the growth of an industry or geographic area creates cost-saving benefits for firms operating within that location. In this case, the technology cluster provides access to specialized suppliers, skilled workers, and shared research facilities. These advantages are created by the wider local environment rather than by one firm acting alone. Option A is incorrect because internal diseconomies occur when a firm becomes too large and experiences higher costs. Option C is incorrect because technical inefficiency means resources are not being used effectively. Option D is incorrect because marginal revenue gains refer to changes in revenue from selling additional output. Question 28. Rapid expansion of an industry in one region leads to congestion, higher land prices, and rising wages for skilled workers. The resulting cost increase is best described as A. Productive efficiency, B. Economies of density, C. Internal economies, D. External diseconomies. The correct answer is D. Let's identify the source of the higher costs. External diseconomies occur when the growth of an industry or region raises costs for firms operating there. In this case, congestion, more expensive land, and stronger competition for skilled workers increase business costs across the area. Therefore, the cost increase comes from the wider industry environment rather than from one firm's internal decisions. Option A is incorrect because productive efficiency means producing output with the least possible resources. Option B is incorrect because economies of density reduce average costs when activity increases within an existing network. Option C is incorrect because internal economies are cost reductions generated within an individual firm as it expands. Question 29. Why is the long-run average cost curve often described as an envelope curve? A. It shows only the firm's highest attainable average cost. B. It traces the lowest attainable average cost across plant choices. C. It records fixed costs at every possible output level. D. It identifies the output where marginal revenue is zero. The correct answer is B. Let's clarify the idea. The long-run average cost curve is called an envelope curve because it traces the lowest average cost a firm can achieve at each output level when it can choose among different plant sizes. Each short-run average cost curve represents a particular scale of operation. The long-run curve touches the lowest points available across those plant options. Option A is incorrect because the curve shows the lowest attainable average cost, not the highest. Option C is incorrect because fixed costs are not fixed in the long run when the firm can change plant size. Option D is incorrect because marginal revenue is unrelated to why the long-run average cost curve is called an envelope. Question 30. Evaluate each statement as true or false. Book depreciation can differ from economic depreciation. The correct answer is true. Replacement cost measures the current sacrifice needed to obtain an equivalent asset or service. The correct answer is true. Non-cash depreciation is irrelevant to profitability analysis solely because no current cash payment occurs. The correct answer is false. An asset's resale value is relevant when it changes the cash flows of a disposal decision. The correct answer is true. Let's work through the cost concepts. Book depreciation is calculated using accounting rules for financial reporting, while economic depreciation reflects changes in an asset's productive capacity or market value. Replacement cost measures what the organization would currently need to give up to obtain an equivalent asset or service. Although depreciation does not require a current cash payment, it still affects reported profit and can matter when evaluating long-term economic performance. Finally, resale value is relevant in a disposal decision because it affects the cash proceeds the organization receives. Question 31. A firm operates a plant persistently below its designed capacity, causing fixed productive resources to remain underutilized. This condition is best described as A. Marginal revenue pricing, B. Productive specialization, C. Excess capacity, D. Constant returns. The correct answer is C. Let's identify the operating condition. Excess capacity exists when a firm operates below the output level that would make efficient use of its available plant and fixed resources. In this case, the plant is persistently underutilized, so some productive capacity remains unused. Option A is incorrect because marginal revenue pricing concerns setting price in relation to marginal revenue. Option B is incorrect because productive specialization refers to concentrating on particular tasks or outputs. Option D is incorrect because constant returns describes output changing in the same proportion as inputs. Question 32. For a price-taking firm, the short-run supply curve is generally represented by the A. Average fixed cost curve, B. Average total cost curve, C. Entire marginal cost curve, D. Marginal cost curve above average variable cost. The correct answer is D. Let's apply the shutdown rule. A price-taking firm produces in the short run where price equals marginal cost, but only when price covers average variable cost. Therefore, the firm's short-run supply curve is the portion of the marginal cost curve above the average variable cost curve. Option A is incorrect because average fixed cost does not determine whether production should continue in the short run. Option B is incorrect because average total cost is relevant to profitability but not the shutdown decision. Option C is incorrect because the marginal cost curve below average variable cost represents output levels where the firm would shut down rather than supply output. Question 33. What condition supports a horizontal long-run industry supply curve in a constant cost industry? A. Input prices and minimum production costs remain unchanged as the industry expands. B. Marginal cost rises continuously as new firms enter the industry. C. Demand becomes perfectly inelastic when firms earn normal profit. D. Individual firms can permanently charge prices above average cost. The correct answer is A. Let's assess the industry condition. A constant cost industry can expand without causing input prices or firms' minimum production costs to rise. As new firms enter and industry output increases, each firm continues to face the same long-run cost conditions. Therefore, the long-run industry supply curve is horizontal at the prevailing long-run equilibrium price. Option B is incorrect because rising marginal cost would create an upward-sloping long-run supply curve. Option C is incorrect because the elasticity of demand does not determine whether the industry is constant cost. Option D is incorrect because competitive firms cannot permanently charge prices above average cost in long-run equilibrium. Question 34. Why is stage 2 of production normally considered the economically relevant range for a variable input? A. Marginal product is positive but declining during this stage. B. Average product is negative throughout this stage. C. Total product falls as more variable input is used. D. Marginal product exceeds average product at every point. The correct answer is A. Let's examine the production stages. During stage 2, each additional unit of the variable input still increases total output. However, marginal product is declining, meaning each extra unit adds less output than the previous one. This is the economically relevant range because the firm is using the variable input productively without reaching negative marginal product. Option B is incorrect because average product is not negative throughout stage 2. Option C is incorrect because total product continues to rise during stage 2. Option D is incorrect because marginal product is below average product during this stage. Question 35. Average product reaches its maximum value when A. Total product reaches 0, B. Marginal product equals average product, C. Marginal cost equals average fixed cost, D. Average variable cost equals average total cost. The correct answer is B. Let's connect the two measures. Average product shows the output produced per unit of the variable input. Again, marginal product shows the additional output produced by one more unit of that input. Average product rises while marginal product is above it and begins to fall once marginal product drops below it. Therefore, average product reaches its maximum where marginal product equals average product. Option A is incorrect because total product does not need to be zero. Option C is incorrect because marginal cost and average fixed cost are cost concepts, not product measures. Option D is incorrect because average variable cost and average total cost do not determine the maximum point of average product. Question 36. A technological improvement raises productivity without changing the cost-minimizing ratio of labor to capital at given input prices. This is A. Neutral technical change, B. Labor-augmenting inflation, C. External diseconomy, D. Price discrimination. The correct answer is A. Let's identify the type of technological change. Neutral technical change improves productivity without changing the relative efficiency of labor compared with capital in the cost-minimizing input combination. Therefore, the firm can produce more output from its inputs while maintaining the same optimal labor-to-capital ratio at given input prices. Option B is incorrect because labor-augmenting change specifically improves the productivity of labor relative to capital. Option C is incorrect because an external diseconomy is a cost increase caused by growth in the wider industry or region. Option D is incorrect because price discrimination involves charging different prices to different customers for the same product or service. Question 37. A new production technology leads firms to use relatively more capital and relatively less labor at unchanged factor prices. This technology is A. Capital saving, B. Output neutral, C. Labor saving, D. Revenue maximizing. The correct answer is C. Let's identify the effect on input use. Labor-saving technological change allows firms to produce using relatively less labor and relatively more capital when factor prices remain unchanged. For example, automated equipment may replace tasks previously completed by workers. Therefore, the technology shifts the cost-minimizing production method toward capital and away from labor. Option A is incorrect because capital-saving change reduces the relative use of capital. Option B is incorrect because output neutral does not describe a technology that changes the preferred input combination. Option D is incorrect because revenue maximization is a business objective rather than a type of technological change. Question 38. Cost elasticity measures the A. Change in price caused by a change in output, B. Percentage change in total cost caused by a percentage change in output, C. Difference between average cost and marginal cost, D. Ratio of total revenue to total fixed cost. The correct answer is B. Let's define the measure. Cost elasticity shows how responsive total cost is when output changes. It compares the percentage change in total cost with the percentage change in output. Therefore, option B is correct. Option A is incorrect because it describes a relationship between price and output rather than cost responsiveness. Option C is incorrect because it compares two cost measures but does not calculate elasticity. Option D is incorrect because total revenue divided by fixed cost is not a measure of cost elasticity. Question 39. A firm charges each customer the maximum amount that the customer is willing to pay for each unit purchased. This pricing method is A. First-degree price discrimination, B. Second-degree price discrimination, C. Peak load pricing, D. Cost-plus pricing. The correct answer is A. Let's distinguish the pricing methods. First-degree price discrimination occurs when a firm charges each customer the maximum price that customer is willing to pay for each unit. This allows the firm to capture the consumer surplus that would otherwise go to buyers. Option B is incorrect because second-degree price discrimination uses quantity discounts or different product versions that buyers select themselves. Option C is incorrect because peak load pricing charges higher prices during periods of high demand. Option D is incorrect because cost plus pricing adds a markup to the cost of providing a product or service. Question 40. A utility offers lower per unit prices when customers choose larger consumption blocks. This practice is most closely associated with A. First-degree price discrimination, B. Second-degree price discrimination, C. Marginal cost pricing, D. Average cost pricing. The correct answer is B. Let's identify the pricing structure. Second-degree price discrimination occurs when prices vary according to the quantity purchased or the product version selected. In this case, customers receive a lower per unit price when they choose larger consumption blocks. Therefore, the pricing schedule encourages buyers to select higher quantities themselves. Option A is incorrect because first-degree price discrimination charges each customer their individual maximum willingness to pay. Option C is incorrect because marginal cost pricing sets price according to the cost of producing one additional unit. Option D is incorrect because average cost pricing sets price based on the average cost per unit. Question 41. A mobile network charges customers a membership fee plus a lower charge for each minute of service used. This pricing structure is a pure load tariff, B, peak load tariff, C, two-part tariff, D, price ceiling. The correct answer is C. Let's identify the pricing model. A two-part tariff combines a fixed access charge with a separate per unit usage charge. In this case, the membership fee is the fixed charge, while the charge for each minute used is the usage component. Option A is incorrect because pure bundling requires customers to buy products or services together as a package. Option B is incorrect because peak load pricing charges higher prices during periods of high demand. Option D is incorrect because a price ceiling is a legal maximum price set by a government or regulator. Question 42. A software firm sells its spreadsheet and presentation applications together for one combined price, while also allowing customers to buy each application separately. This is A. First-degree pricing, B. Rate of return regulation, C. Single product pricing, D. Mixed bundling. The correct answer is D. Let's identify the pricing approach. Mixed bundling allows customers to buy products individually or together as a package. In this case, buyers can purchase the spreadsheet application, the presentation application, or both applications at one combined price. Therefore, the firm is using mixed bundling. Option A is incorrect because first-degree pricing charges each buyer according to their individual willingness to pay. Option B is incorrect because rate of return regulation controls the profit a regulated firm can earn on its invested capital. Option C is incorrect because single product pricing involves setting a price for only one product rather than offering a combined package. Question 43. Evaluate each statement as true or false. Gross revenue automatically equals net revenue after returns and allowances occur. The correct answer is false. A credit sale can increase recognized revenue before cash is collected. The correct answer is true. A rebate granted after purchase necessarily increases net revenue. The correct answer is false. Revenue cannot be recognized until every related cash cost has been paid. The correct answer is false. Let's examine the revenue concepts. Gross revenue is the total amount earned before deductions such as returns, discounts, allowances, and rebates. Therefore, net revenue can be lower than gross revenue. A credit sale can create recognized revenue and an accounts receivable balance before the customer makes payment. Furthermore, a rebate normally reduces the final amount the business earns from the sale. Revenue recognition depends on whether the business has satisfied the conditions for earning revenue. It does not depend on paying every cost connected to that sale. Question 44. A hotel charges substantially higher room prices during a major international event because demand is unusually high and room capacity cannot expand in the short run. This is A. Peak load pricing, B. Cost plus pricing, C. Predatory pricing, D. Average cost pricing. The correct answer is A. Let's identify the reason for the higher price. Peak load pricing involves charging higher prices during periods of unusually high demand when available capacity is limited. In this case, the major international event increases demand for hotel rooms, while the hotel cannot quickly add more rooms. Therefore, the hotel raises prices during the peak demand period. Option B is incorrect because cost-plus pricing sets a price by adding a markup to cost. Option C is incorrect because predatory pricing involves setting very low prices to weaken competitors. Option D is incorrect because average cost pricing sets prices in relation to the average cost of providing the service. Question 45. A regulated utility must recover fixed costs while minimizing the efficiency losses caused by pricing above marginal cost. Which pricing principle is most appropriate? A. Charge identical markups to every customer group. B. Charge prices equal to average variable cost. C. Apply larger markups where demand is less elastic. D. Apply lower prices where fixed costs are highest. The correct answer is C. Let's apply the pricing principle. Ramsey pricing is used when a regulated firm must recover fixed costs while reducing the efficiency loss caused by prices above marginal cost. It applies larger markups to customer groups with less elastic demand because their quantity demanded changes less when prices rise. This allows lower markups for customers who are more price sensitive. Option A is incorrect because identical markups do not account for differences in demand elasticity. Option B is incorrect because pricing at average variable cost would not necessarily recover the utility's fixed costs. Option D is incorrect because prices should be guided by demand responsiveness rather than by where fixed costs are highest. Question 46. A regulator replaces a cost-plus rule with a price cap adjusted for expected productivity gains. What incentive does this create for the regulated firm? A. Reducing costs below the cap can increase profit. B. Raising reported cost automatically increases allowed prices. C. Increasing fixed cost guarantees a larger return. D. Reducing output eliminates the regulatory constraint. The correct answer is A. Let's examine the incentive effect. Under price cap regulation, the regulator sets a maximum price that the firm can charge, often adjusted over time for expected productivity improvements. If the firm reduces its costs while staying within that cap, it can keep part or all of the efficiency gain as higher profit. Therefore, price cap regulation encourages stronger cost control than a cost-plus rule. Option B is incorrect because reported costs do not automatically raise the allowed price under a price cap. Option C is incorrect because higher fixed costs do not guarantee a larger return. Option D is incorrect because reducing output does not remove the price cap or end the regulatory requirement. Question 47. A natural monopoly has marginal cost below average total cost at the output that maximizes allocative efficiency. If it is required to charge marginal cost, the firm will most likely A. Earn excess economic profit, B. Operate with price above average total cost, C. Eliminate all fixed production costs, D. Require a subsidy to avoid a financial loss. The correct answer is D. Let's apply the pricing outcome. A natural monopoly often has high fixed costs, which cause average total cost to remain above marginal cost at the efficient output level. If the firm charges a price equal to marginal cost, its revenue will not be enough to cover total cost. Therefore, the firm will make a financial loss unless it receives a subsidy. Option A is incorrect because marginal cost pricing would not create excess economic profit in this situation. Option B is incorrect because price is equal to marginal cost, which is below average total cost. Option C is incorrect because marginal cost pricing does not eliminate the firm's fixed production costs. Question 48. For a profit-maximizing firm with market power, a more elastic demand curve is generally associated with A. A larger markup above marginal cost, B. A higher fixed cost recovery requirement, C. A lower marginal product value, D. A smaller markup above marginal cost. The correct answer is D. Let's connect elasticity to pricing power. A firm with market power can charge a markup above marginal cost. However, when demand is more elastic, customers respond more strongly to a price increase by reducing their purchases. Therefore, the firm has less ability to set prices far above marginal cost and will generally apply a smaller markup. Option A is incorrect because a larger markup is more likely when demand is less elastic. Option B is incorrect because fixed cost recovery does not determine the relationship between demand elasticity and markup. Option C is incorrect because marginal product value concerns the productivity of an input rather than the firm's pricing decision. Question 49. Managers seek to maximize sales revenue but must achieve a minimum acceptable profit for shareholders. This objective is most accurately described as A. Revenue maximization, subject to a profit constraint. B. Cost minimization, subject to a revenue constraint. C. Marginal cost pricing, subject to a tax constraint. D. Price discrimination, subject to a capacity constraint. The correct answer is A. Let's define the objective. Revenue maximization subject to a profit constraint means managers aim to achieve the highest possible sales revenue while still meeting a minimum required profit level. The profit requirement limits how far the firm can pursue additional revenue if doing so would reduce profit below the acceptable threshold. Option B is incorrect because the main objective is increasing revenue rather than minimizing cost. Option C is incorrect because marginal cost pricing focuses on how prices relate to the cost of one additional unit. Option D is incorrect because price discrimination concerns charging different prices to different buyers or market segments. Question 50. A firm launches a lower price tablet and most buyers switch from the firm's existing premium tablet rather than entering the market for the first time. This outcome is called A. Price leadership, B. Market segmentation, C. Product cannibalization, D. External economy. The correct answer is C. Let's identify the sales effect. Product cannibalization occurs when a new product takes sales away from an existing product offered by the same firm. In this case, buyers move from the premium tablet to the lower priced tablet rather than creating additional sales for the firm. Therefore, the new tablet reduces demand for the existing premium model. Option A is incorrect because price leadership involves one firm setting a price that competitors may follow. Option B is incorrect because market segmentation divides customers into groups with different needs or characteristics. Option D is incorrect because an external economy is a cost advantage created by wider industry or regional growth. Question 51. A digital platform initially charges a low price to rapidly attract users because the service becomes more valuable as the user base expands. This strategy primarily seeks to A. Eliminate all variable costs. B. Create a downward sloping supply curve. C. Build an installed base through network effects. D. Guarantee normal profit in the short run. The correct answer is C. Let's consider the strategic goal. Penetration pricing uses a low initial price to attract a large number of users quickly. When network effects are present, the service becomes more valuable as more people join and use the platform. Therefore, the firm is seeking to build an installed base that strengthens the value of the service over time. Option A is incorrect because low pricing does not eliminate variable costs. Option B is incorrect because a downward sloping supply curve is not the objective of this pricing strategy. Option D is incorrect because the firm may accept lower short-run profit while it builds its user base. Question 52. An airline changes fares and seat availability based on predicted demand, booking timing, cancellation patterns, and remaining seat capacity. This practice is A. Revenue management, B. First-degree pricing, C. Cost-push inflation, D. Perfect competition. The correct answer is A. Let's identify the strategy. Revenue management uses demand forecasts and capacity controls to increase revenue from limited capacity that cannot be stored for later use. In this case, airline seats are perishable because an unsold seat on a departing flight cannot be sold after takeoff. Therefore, the airline adjusts fares and seat availability according to expected demand, booking patterns, cancellations, and remaining capacity. Option B is incorrect because first-degree pricing charges each buyer their individual maximum willingness to pay. Option C is incorrect because cost-push inflation occurs when rising production costs lead to higher prices. Option D is incorrect because perfect competition describes a market structure with many firms selling identical products. Question 53. A firm introduces a highly innovative product at a high initial price and gradually lowers the price as competitors enter and demand broadens. This strategy is A. Penetration pricing, B. Predatory pricing, C. Marginal cost pricing, D. Price skimming. The correct answer is D. Let's identify the launch strategy. Price skimming involves setting a high initial price for a new or highly innovative product. The firm earns revenue from customers with a high willingness to pay before gradually reducing the price to reach more price-sensitive buyers. Therefore, the strategy captures early demand at a premium before competition intensifies. Option A is incorrect because penetration pricing starts with a low price to attract a large market quickly. Option B is incorrect because predatory pricing involves setting prices very low to weaken or drive out competitors. Option C is incorrect because marginal cost pricing sets price close to the cost of producing one additional unit. Question 54. For a firm that sells output in a competitive market, the monetary value created by an additional unit of labor is measured by A. Average revenue product, B. Marginal factor cost, C. Average variable cost, D. Value of marginal product. The correct answer is D. Let's identify the labor measure. Value of marginal product measures the additional revenue created when the firm employs one more unit of labor. In a competitive output market, it is calculated by multiplying the worker's marginal product by the market price of the output. Therefore, it shows the monetary value of the extra output produced by that additional worker. Option A is incorrect because average revenue product measures average revenue generated per unit of labor. Option B is incorrect because marginal factor cost is the extra cost of hiring one more unit of an input. Option C is incorrect because average variable cost measures variable cost per unit of output. Question 55. Evaluate each statement as true or false. Internal failure costs arise only after products have reached external customers. The correct answer is false. Prevention costs aim to reduce defects before failures occur. The correct answer is true. Appraisal costs are incurred to assess conformity with quality standards. The correct answer is true. Warranty repair costs are examples of external failure costs. The correct answer is true. Let's review the quality cost categories. Internal failure costs occur before goods or services reach the customer, such as scrap, rework, or correcting defects during production. Prevention costs are incurred to avoid defects before they happen, for example, through quality training and process improvement. Appraisal costs involve inspecting, testing, and assessing whether products meet required quality standards. Finally, warranty repairs occur after customers have received the product, so they are classified as external failure costs. Question 56. A price-taking firm hires labor in a competitive labor market. It should continue hiring additional workers until A. Average product equals marginal product. B. Total revenue equals total fixed cost. C. Value of marginal product equals the wage rate. D. Marginal factor cost becomes lower than average cost. The correct answer is C. Let's apply the hiring rule. A competitive firm hires an additional worker when the value of that worker's marginal product exceeds the wage rate. It stops hiring when the value of marginal product equals the wage rate because the extra revenue from the final worker exactly matches the cost of employing that worker. Option A is incorrect because average product and marginal product describe output relationships, not the profit-maximizing hiring rule. Option B is incorrect because total revenue and total fixed cost do not determine the number of workers to hire. Option D is incorrect because the relevant comparison is between value of marginal product and the wage rate. Question 57. A single dominant employer faces an upward-sloping labor supply curve. To hire one additional worker, it must raise wages for existing workers. Under these conditions, marginal factor cost is A, equal to the wage rate at all employment levels, B, lower than the wage rate because labor supply rises, C, higher than the wage rate because wage increases apply more broadly, D, independent of labor supply because output price is fixed. The correct answer is C. Let's examine the hiring condition. A single dominant employer in the labor market is a monopsonist. To attract an additional worker, it must offer a higher wage. However, that higher wage also applies to existing workers. Therefore, the total increase in labor cost is greater than the wage paid to the additional worker. This causes marginal factor cost to be higher than the wage rate. Option A is incorrect because marginal factor cost equals the wage rate in a competitive labor market. Option B is incorrect because marginal factor cost is higher, not lower, than the wage rate under monopsony. Option D is incorrect because the upward sloping labor supply curve directly determines the relationship between marginal factor cost and wages. Question 58. Demand for specialist machine operators declines after demand for the final manufactured product falls. This illustrates A, derived demand, B, perfectly elastic supply, C, neutral technical change, D, marginal cost pricing. The correct answer is A. Let's connect the two markets. Derived demand means demand for an input depends on demand for the final product or service that the input helps produce. In this case, lower demand for the manufactured product reduces the need for specialist machine operators. Therefore, labor demand falls because demand for the final output has declined. Option B is incorrect because perfectly elastic supply describes a supply condition where quantity can change without affecting price. Option C is incorrect because neutral technical change improves productivity without changing the optimal input ratio. Option D is incorrect because marginal cost pricing sets price in relation to the cost of producing one additional unit. Question 59. A uniquely located piece of land earns payment above the minimum amount needed to keep it in its current use. The excess payment is A, economic rent, B, marginal revenue, C, sunk cost, D, normal profit. The correct answer is A. Let's identify the payment. Economic rent is the payment earned by a resource above the minimum amount required to keep that resource in its current use. In this case, the land earns more because its location gives it a particular advantage. Therefore, the excess payment is economic rent. Option B is incorrect because marginal revenue is the additional revenue earned from selling one more unit. Option C is incorrect because a sunk cost is a past cost that cannot be recovered through a current decision. Option D is incorrect because normal profit is the minimum return needed to keep an entrepreneur's resources in their current use. Question 60. In the short run, the owner of a scarce machine earns returns above the machine's variable operating cost because its supply cannot quickly expand. These returns are called A, producer surplus, B, normal profit, C, opportunity revenue, D, quasi-rent. The correct answer is D. Let's identify the short-run return. Quasi-rent is the return earned by a fixed factor of production when its supply cannot increase quickly in the short run. In this case, the machine is scarce and fixed in supply, so the owner can earn returns above its variable operating cost. Therefore, those returns are classified as quasi-rent. Option A is incorrect because producer surplus is the difference between the price received and the minimum amount producers are willing to accept. Option B is incorrect because normal profit is the minimum return needed to keep entrepreneurial resources in their current use. Option C is incorrect because opportunity revenue is not the correct term for this type of short-run return.